Welcome to Iron Financial. Our mission here is simple: to forge a stronger portfolio for you by cutting right through all the market weakness. Today, we're grabbing our hard hats and we're heading out to inspect Charter Communications. You know them, ticker CHTR. And let me tell you, their latest earnings report, it is a structural engineer's worst nightmare. I mean, on one side, you've got this gleaming, beautiful wall of new growth. It looks fantastic. But on the other side, the original foundation of the house is literally crumbling into dust. So our job today is to inspect this entire structure, from the roof all the way down to the bedrock, and figure out once and for all if this company is built of solid iron or if it's just covered in a thick layer of rust. Let's get into it.
Okay, let's just get right to the heart of the issue. No messing around. You really can't look at Charter as a single company anymore. It just doesn't work. You have to see it as two completely separate businesses fighting for control under one single roof. So first up, you have the legacy business. You know, the massive internet and video services that built this entire empire in the first place. Well, the numbers there, they are flashing bright red. I mean, they're just bleeding customers and revenue left and right. And then you've got the new kid on the block, Spectrum Mobile. This part of the company is on absolute fire, growing at a pace that's just blistering. So the entire investment thesis, really every single dollar that's bet on this stock, it all boils down to one simple, pretty brutal question. Can that new growth engine replace the old one before the whole thing comes crashing down on itself?
So here's how we're going to tackle this. This is our inspection plan. We've already touched on Section 1, what we're calling the house divided, that central conflict between the old business and the new. Now we're going to move on to Section 2, and we're going to really examine the cracks in the core to see just how deep the damage goes. From there, in Section 3, we'll take a hard look at the mobile reinforcement they're trying to build up. After that, and this is maybe the most critical part, we're diving into Section 4, the $94 billion foundation of debt that this whole company is sitting on. And then finally, in Section 5, we will deliver our verdict. Is this an opportunity to buy real strength, or is it a trapdoor just waiting to spring?
All right, time to get to work. Section 2, the cracks in the core. This is where the whole story really begins. And folks, it is not a pretty picture. Charter's traditional business segments, the ones that, let's be honest, generate the vast majority of the cash, are showing some very serious signs of decay. Before we can even begin to talk about new growth, we absolutely have to understand the magnitude of this problem, because this erosion, this is the force that's threatening to pull the entire structure down.
Now let's really get into these numbers. What's so telling on this slide is just how widespread the decline is. Don't just glance at the percentages, okay? Look at the raw numbers with me. Start at that top line, total customer relationships, down 1.5% year over year. That might not sound like a catastrophe, but in real numbers, that's nearly 500,000 customers, 477,000 to be exact, who have just walked away. Then you look at the all-important internet segment, their cash cow. It's down by the same amount, a loss of 464,000 subscribers. And voice, well, that line item is in an absolute freefall, down over 11%. This isn't just one leaky pipe we're talking about. This is systemic erosion across the entire legacy foundation. It's a flood.
You know, some people might say, hey, losing customers is just the cost of doing business in a super competitive market. But here at Iron Financial, we look for trends. And this bar chart, well, it illustrates a really dangerous one. Let's just focus on the most critical metric they have, internet net adds. Look at the first quarter of last year. They lost 59,000 customers. Bad, for sure, but maybe you could argue it's manageable. But then fast forward to the end of last year. That loss more than doubled to 119,000. And this latest quarter, another 120,000 gone. This is not a blip. This is an accelerating trend of decay. The pressure from fiber and fixed wireless competition is clearly getting more intense, and it's chipping away at their core asset with more and more force every single quarter.
Whoa, hold on a second. This is where I have to jump in, because this right here is the number that really sets off the alarm bells for me. I mean, look, losing customers is one thing, it's a huge problem, but this screen shows something that might be even deeper. It's not just that people are leaving, they're actually making less money from the customers who are sticking around. A 1.4% decline in monthly revenue per residential customer, what does that tell you? It tells me their pricing power is evaporating. It means they're being forced to throw out cheaper promotional packages just to keep people from cutting the cord completely. So what you have is a shrinking customer base that is also becoming less profitable on a per-person basis. That is a truly nasty combination. That's a crack that can spread very, very quickly through the entire foundation.
That's a sharp point, and honestly, it's the perfect transition. Let's move on to our next section of this inspection. Section 3, the mobile reinforcement. So while that old concrete foundation is decaying and cracking, management is frantically, and I mean frantically, trying to put up a brand new pillar of growth with their mobile business. They are pouring a ton of resources into this, and on the surface, you gotta admit, the results look pretty impressive. The big question, though, is whether this new steel beam is actually strong enough to support the immense, crushing weight of the crumbling structure right next to it.
Just look at this chart. I mean, it is the perfect mirror image of the internet business we just looked at. A year ago, they added a massive 507,000 mobile lines in just one quarter. Last quarter, still a very strong 428,000, and this quarter, another 368,000. Now, yeah, okay, you can see the pace of the ads is slowing down a bit, and that is absolutely something we need to watch. But let's be real, these are still huge numbers. What this shows is they are successfully leveraging their massive existing customer base to cross-sell a brand new, high-growth product. And this, right here, is the bull case in a nutshell. They're trying to build a new growth engine right inside the shell of the old dying company.
And let's be clear, this isn't some little side project or a science experiment they're running in a back room. No, this is a business that's operating at serious scale. We're talking 12.1 million total mobile lines. That's up over 17% in a single year. Think about that. In just a few short years, they've gone from literally nothing to becoming one of the fastest growing mobile providers in the entire country. They've built a legitimate multi-billion-dollar business from a complete standing start. So the crucial takeaway here is this. This mobile reinforcement, it's real, it is substantial, and it is growing incredibly fast.
Okay, the numbers are impressive. I'll give you that. The growth itself is undeniable. But here's my question. Is this real foundational growth that can actually support the entire $94 billion company? Or is this just some cheap decorative cladding they've slapped on the side of a decaying building to distract all of us from the cracks? Come on, a business isn't just about adding customers. It's about adding profitable revenue. How much money is this mobile business actually bringing in? And more importantly, is it anywhere near enough to fill the massive gaping hole being left by the decline in their internet and video businesses? Show me the revenue. That's what I want to see.
That is an excellent question that gets right to the absolute heart of the matter. And this table, well, it lays it all out in black and white. Mobile service revenue, you can see it on the far right, is indeed growing fast, up over 15% year over year to just over $1 billion for the quarter. And that is a significant number, no doubt. But, and this is a big but, look at what it's up against. The internet business, even after declining 1.3%, still brought in $5.8 billion. And the video business, which basically fell off a cliff at over 9% down, still generated $3.2 billion. So let me put it this way. For every single dollar of new mobile revenue they added this quarter, they lost about $3 from their legacy video business alone. This right here, this is the central problem. The mobile reinforcement is strong, but the weight it needs to support is just immense, and it is getting heavier by the day.
Which brings us to the bedrock of this entire operation. Welcome to Section 4, the $94 billion foundation. Everything we've talked about so far, all the cracks, all the reinforcements, it all rests on this one thing. You see, a company with this much leverage has absolutely zero room for error. We need to do a thorough structural inspection of this debt. So is it a stable foundation, or is it just a massive anchor that's going to drag the whole structure down to the bottom of the ocean?
Just take a second and look at that number, $94.3 billion. Let that sink in for a moment. That is an astronomical amount of leverage. For many, many companies, this would be an immediate fatal flaw. A debt load of this size can amplify every tiny problem into a full-blown company-ending crisis. But here's the thing with debt. The total amount is only half the story. The other, and arguably more important half, is the structure. How has management actually built this foundation?
And this right here is where the bull case gets its real strength. Look at this maturity profile. You have to hand it to them. Management has been incredibly intelligent here. They've built what we call a debt wall, but what they've done is they've pushed it far, far out into the future. 93% of their debt doesn't even come due until after 2028. Now, yeah, there's a pretty significant tower of maturities looming in 2029 through 2031, but that gives them a 5-year runway. It gives them a 5-year window to try and turn this ship around. It is a calculated gamble for sure, but it's a gamble they have time to win. This doesn't look like panic. It looks like a very deliberate, very long-term financial strategy.
And here's the other pillar of their financial fortress. 88% of that $94 billion is fixed-rate debt. So what does that really mean? It means they are largely insulated from the risk of rising interest rates. So while all these other highly leveraged companies are getting absolutely crushed by higher interest payments, Charter has locked in their costs for the vast, vast majority of their debt.
This is a massive strategic advantage. It gives them predictability and stability in what is a very volatile macroeconomic environment. It's basically a shield against uncertainty.
And this is the end result. This chart here shows their consolidated net leverage over time. And despite the absolutely massive absolute debt number, the ratio of their debt to their earnings has remained remarkably stable, right within their target range, ending the quarter at 4.15 times. So to the bulls, this is the final piece of evidence. The debt is huge, yeah, but it is not an immediate problem. It's well structured, it's primarily fixed rate, and the leverage ratio is under control. The foundation, they're going to argue, is solid iron.
Stop right there. A stable leverage ratio is a dangerous illusion when the E in EBITDA is shrinking. I mean, come on, that E stands for earnings, right? It's the engine that supports the entire debt structure. So you can't sit here and tell me the foundation is stable if the very ground underneath it is washing away into a sinkhole. Their adjusted EBITDA fell 2.2% this quarter. So the ratio is only stable because the denominator hasn't fallen fast enough, yet. A stable ratio is like a calm sea right before a hurricane. The real question is, what happens when that hurricane of declining earnings actually hits? Do they have enough cash flow to service this massive debt and make the huge capital investments they need to stay competitive? Because that's all that really matters.
And that is the absolute crux of the bear case. This slide confirms your concern perfectly. Just look at the squeeze. Adjusted EBITDA, their core profitability metric, fell 2.2%. At the exact same time, their capital expenditures, that's the money they have to spend on network upgrades and expansion just to keep up with the competition, it jumped by a massive 19%. So what happens when earnings go down and spending goes way up? Your free cash flow gets absolutely crushed. And you see it right there, it fell over 12% year over year. This free cash flow, this is the mortar that's holding the whole company together. It's what they use to pay down debt, buy back stock, and weather any storms. And right now, it is shrinking. They are spending more to earn less. That is a recipe for disaster.
Okay, let's step back for a minute and survey the entire structure. We've inspected the cracks, we've tested the reinforcements, and we've drilled all the way down into the foundation. It is time for our final section. Section 5, the verdict. We've seen really compelling evidence on both sides of this argument. So is this company a solid piece of iron that's just getting a new coat of paint, or is it a rusting hulk that's literally being eaten away from the inside out?
All right, let's lay out the final arguments, head to head. The case for this stock being pure iron, it rests on a few key pillars. First, that explosive mobile growth is creating a genuinely powerful new engine for the company. Second, that $94 billion debt load, while absolutely huge, is pretty brilliantly managed with long maturities and fixed rates, which gives them breathing room. Third, the leverage ratio is stable, right where management wants it. And finally, they are still generating enough cash to buy back almost $1 billion of their own stock in a single quarter, which provides a nice floor for the share price. But the case for this whole thing being a pile of rust is just as compelling. The core internet business, the very heart of the company, isn't just leaking, it's hemorrhaging, and that decline is accelerating. Top-line revenue and bottom-line EBITDA are both shrinking. The massive capital spending that's required to even compete is putting a death grip on their free cash flow. And that well-managed debt? Come on, it's only manageable as long as earnings don't fall off a cliff. The entire structure, the whole thing, depends on their ability to stop the bleeding in the core business, and so far, there is zero evidence they can actually do it.
So here's the bottom line. The structure of Charter Communications is absolutely massive, and its financial engineering for now is holding it all together. But our inspection is crystal clear. The core is eroding. The critical question for any investor looking at this name is brutally simple. Can they reinforce the building with new mobile growth faster than the legacy foundation crumbles? That is the entire game. The answer to that question is going to determine whether this stock is a powerful engine for your portfolio or just a pile of rust. Right now, the market is betting they can't. The stock is down big. The question you need to ask yourself is the market right? That's what you need to decide. This is Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.